Morning, everyone. Ed Bartling, your external wholesaler for financial markets. And before I introduce our presenter for today, I want to, on behalf of financial markets, all of us here, we want to thank you for your business in 2021. By you looking at the risk out there for your clients and looking at possible solutions, we thank you again so very much for putting that trust with us to help you with the clients for those different needs as they do come up. Looking forward to 2022 on all the opportunities that are set before us here. To start off, let me share just a real quick here to kind of set the stage a little what I call rocking chair wisdom. It goes like this. Now, if you only had an hour to chop down a tree, this person said, I would spend the first 45 minutes sharpening my axe and then cut down that tree. Folks, that was shared with us with one of our presidents, Abraham Lincoln. You see, a dull axe or the wrong tool for the job will not allow you to work quickly and efficiently to achieve your goal. So I thank you so much for this morning of being here to sharpen your axe. And I can't think of a better axe sharpener than our presenter today. Today we have Brent DeGroot. He is the Regional Sales Director for OneAmerica, and he pretty much has, I believe, the Midwest. Now, part of his responsibilities is working for IMOs like ourselves and helping us then support and to drive growth for particular risks, particularly the long-term care risk. Now, Brent indeed is a veteran in the long-term care and life insurance brokerage space. He's very, very close, folks, to a quarter of a century of experience there in those two arenas there. Brent holds professional designations of the long-term care CLTC designation and the long-term care professional, the LTCP designation. My goodness, Brent, you got more degrees than a thermometer. His education, he's an alumni of the University of Nebraska at Omaha. Now, being in Nebraska, which he resides in Omaha with his family, no doubt some of you can identify sometimes Nebraska with sports. You know, Nebraska doesn't have too bad of a football team, knowing that they're known for their volleyball program, number 2 in the nation this year, and particularly for their bowling. Nebraska, 13th consecutive number 1 titles in bowling. So not too bad of a football program there. As I said, Brent is going to be here today to share with us in looking at that risk management and showing us some then different tools to sharpen that axe on are your clients self-funding that long-term care risk. Brent, I turn it over to you.
Well, Ed, thank you for those words of wisdom early on. And yes, we do have a decent football team. They've fallen on some hard times lately, but hopefully they'll make their way back. But we've certainly got some other good sports there that you mentioned, volleyball and bowling as well. So, but that's not why we're here, folks. But Ed and everybody at Financial Markets, I certainly want to thank you for the buying here, the opportunity to speak to everybody, and those that came out today. I want to thank you for your time and attention today. It is very important, and just appreciate you being here. Well, I like to address the self-funding risk for long-term care, and I'll start with just looking at this picture that's on the screen. You know, this couple around the dinner table here, all smiles, happy. You know, a lot of these types of pictures are all that way. Everybody's all happy and smiley, but you know, they may be self-funding their long-term care risk, and while they may be smiling today, if and when they are self-funding the risks of long-term care, those smiles can quickly turn to frowns or even some peril on their faces when they realize how expensive and how big of a risk planning to self-fund that risk can be. So today I really wanted to go into looking at some of those risks and ways to really mitigate that risk and really put the client's minds at ease with some of the solutions that we have here at OneAmerica. Now, before I get started there, I do want to talk about quickly, we're a leader in this market space, the asset-based LTC marketplace. And so we've been an innovator in this space, one of the first to market with these types of plans. And what does that mean? Well, the traditional space has been around for many, many years. Now almost 40 years in the traditional market. But there were some risks that came along with that and reasons that the American consumer wouldn't look to protecting themselves through a traditional policy. And largely, there were risks of potential rate increases down the road. With the asset-based marketplace, you have the protection from that. These are based on either a life insurance chassis or an annuity chassis. So all premiums are all guaranteed. Not only that, you're going to have either a cash value or a death benefit that is guaranteed. You're going to have guaranteed LTC benefits as well. So lots of guarantees in the asset-based space, and that is what is making the rise of covering the LTC risks more attractive in this asset-based marketplace. And I will say, we've been doing this now for 34 years. Our first iteration, if you will, of our asset care was released in 1988. It happens to be the year I graduated from high school. So I guess that gives you some insight into how old I am. But, this asset-based space, so we've been doing this obviously for 34 years. So what's good to know about that is the fact that we've been designing these plans, administering these plans, and certainly when the rubber meets the road, paying claims on these types of plans as well for 34 years. So it's always good to be with a market leader when you're talking to your clients about any asset-based long-term care market mitigation. Looking at our financial strengths there, we can trace our roots at OneAmerica all the way back to 1877. So we've been a long time in the insurance marketplace, but we're AM Best A+ rated. And if you follow Comdex, our current Comdex score is 95. So that all speaks to the financial strength of who OneAmerica is as well. And I also want you to know that we are a mutual company, meaning we report to those same policy owners that purchase our policies. So we're always thinking in terms of how we can best these types of solutions for our policyholders, and that's who we report to. So we're not trying to design plans and pay claims and mitigate, basically reporting to stockholders in our company. We are reporting to those direct policyholders that own our policies, and we're always thinking of them first. So we're very committed to being there when our clients need them the most. So that's enough about Mutual of Omaha. As you can tell, where I used to work. Enough about OneAmerica there. What I did want to kick off this presentation with, though, today is here at OneAmerica, we had a Leading Tomorrow speaker series for the last 2 years. And one of our speakers on this was Ed Slott, and he is the self-proclaimed America's IRA expert. If you have never heard of Ed Slott, I would, recommend you get out the Google machine and look him up. He's a best-selling author, TV personality, professional speaker, but he is nationally recognized as an IRA distribution expert out there. And when we had him on in the 2020 year in our Leading Tomorrow speaker series, one of the things that I really took away from his presentation was this, that all of our clients really want three main things. They want more control over their money and how it can be used and how they can access it. They want to pay less taxes, right? Nobody wants to pay more taxes. They all want to pay less taxes, and maybe there's ways to mitigate that taxation. And then they want to pass along larger inheritances. Now, that can be an inheritance to a child, some other family member, or it could even be a charitable organization that they want to. But they want to pass on larger amounts to those typical individuals. So when I'm going through this presentation today, I'm going to be focusing on these three things when we're talking about some of the solutions. So self-funding is always the largest barrier or reason that people will maybe not plan to mitigate any long-term care expenses, whether they're in their retirement years or whenever that may happen. But they many times may feel that they've got enough money. Maybe they've been told that they have enough money that they can just self-fund this risk. But let's look at what can happen when they're self-funding. So what I've got up here is a very well-balanced portfolio. Your aggressive, moderate, and conservative funds. So very well-balanced. We hope that all portfolios look somewhat like this, and most do. Obviously, your aggressive funds are poised for significant growth. You've got your moderate that are, positioned for growth, but not as much, downside risk, if you will. And then your conservative funds, which are really there to preserve principal and many times have guarantees with them. Well, now let's look at a typical long-term care situation. If a client or clients, if they're married, are self-funding this risk, let's look at what the cost of 1 year of care could be. Now, this may not be a Midwest number, if you will. It may be slightly lower, around 100,000. But when I'm doing this across the nation, to get more of a median average, 125,000 is a fairly median amount for a long-term care risk for one individual for a year. Now, you can see they pull that out of their well-balanced portfolio. Again, largely it's probably going to come from that conservative fund area, or maybe a mix of moderate and conservative. Is that going to invade their total portfolio that greatly? No. Is that really going to change things for them greatly? No, it probably will not. But that is just 1 year of care, and that is only one individual if they are married. Let's look at multiple years of care, and we can see how quickly a long-term care event for any extended period of time can quickly eat up that whole portfolio. So the self-funding notion of covering the long-term care risk is probably not the best option for them out there. And I'm really going to go through some scenarios here today that can show them a better way to mitigate this risk versus self-funding. Although it can look similar to self-funding because they have still control over that money. Again, as Slot said, they want more control, less tax, and larger inheritances. So again, we're going to keep that theme going throughout this presentation today. Now, before I get into more of what I was talking about and how we get into the solutions, I really want to make sure that everybody understands this concept of our care solutions portfolio. And it's pretty straightforward, but I like to simplify it as much as I can. And essentially, it is a base policy, and that base policy could either be a life insurance, which we call our asset care solutions, or an annuity, which we call our annuity care solutions. So it's your base policy, either life or annuity. And there's many ways that you can fund these types of base plans. Single premium, obviously with cash or wherever they want to get that single premium from. We can use qualified funds, and I'm going to touch on that just a little bit here as well. Many advisors and even more Americans, consumers, don't understand that you can use qualified money to create a long-term care plan. We can do it either in like I said, a single premium or recurring premiums. And we've got a number of options there: 5-pay, 10-pay, 20-pay, pay to age 95. That is still a paid up option if they reach 95, but that's really more of our annual pay, if you will. So we've got a lot of ways that we can fund these types of base policies. And then don't forget your 1035 opportunities, non-qualified annuities or cash values from life insurance that maybe they've outlived the use for why that life insurance was put in place in the first place. So that's the way we can fund these base policies. So two pieces here. We've got the base policy, which I've described, and then the ability to add a rider. That rider is called the continuation of benefits. Funding options there are very similar to what we have on the base policy, but if you get this concept of it's a base policy plus a rider, this is what is putting these long-term care plans in place, but still giving them more control, less taxation, and certainly potentially larger inheritance for whoever they want to pass any legacies to. So get that concept, base and rider here. Now I'm going to start really on the annuity side today. I normally start on the life side, so I'm going to switch things up just a little bit. And I want to give you some quick statistics here on the annuity market space. I'm not a big statistical person, but I think that this really kind of sets the stage, if you will. So if we look at total retirement annuity assets out there from the American public, we are now over $2 trillion in the retirement annuity assets that's out in the space. So it's a vast, vast market space to tap into. If you look at total annuity sales in 2020 alone, $219 billion was spent for annuities in 2020 alone. So again, a very large market space. And then if we look at the average age for those purchasing, say, non-qualified annuities, we see that the average age there is 51 years. Now, the reason I point that out is because if they purchase one, say at their average or somewhere right around that average time frame, and now we're looking to plan with our particular clients at maybe age 60 or 70, somewhere in that range, we can look to see if they happen to have any non-qualified annuities out there. Do they have that in their retirement portfolio? Many times what clients have done is added this annuity because at that average age here of 50 or 51, whatever you want to call it, that looked like a very attractive option to them. Look, I'll just put some money away in this annuity. I know it will grow, and eventually I can use that for whatever. And when I say whatever, many times you may not even understand or know, they may not have even told you that they've got a non-qualified annuity out here. Largely, they may have purchased that for maybe, income options later in life. But many people die even without turning on those income options on their annuities. And originally why they bought it was just, hey, I want to park some money over here. I want to let it grow tax deferred, and I'll use that just in case. Well, if you ask them questions about what that just in case money is, 9 times out of 10, you're going to hear your clients describe what is essentially a long-term care event. And why not use some of these non-qualified annuities that are out there to plan for any long-term care mitigation? So if we continue in this marketplace, really people buy annuities typically for 4 main reasons. 1, the growth. 2, the tax deferral. Like I said, they want less taxes, right? So they're purchasing these with the ability for growth and tax deferred. They may want guaranteed income, want to turn on that income rider at some point. Or the 4th one is to guard against any catastrophic illness. So if these are the 4 main reasons that they're purchasing non-qualified annuities, I like to ask clients this one question. is their non-qualified annuity where it should be? And I would just pose that question for you as well. Maybe this is a question you want to put in your arsenal as well. When you're talking with your clients, again, they may have never even told you about this annuity that they took out, 10, 20, 30 years ago, and it's just been growing tax deferred for many, many years. Is it where it needs to be? And why do I say that? Well, largely it's due to the Pension Protection Act, or PPA, as it's many times referred to. The PPA was enacted in 2006 and actually rolled out in 2010. So it's been available now for, at least 12 years. And what I like about the Pension Protection Act is what it allowed for is the 1035 exchanging of a non-qualified annuity into another non-qualified annuity that is Pension Protection Act eligible. All of the solutions that we have here at OneAmerica, all of our annuity care solutions are just that. They're PPA eligible products or solutions for your client. And why do I say that? Why is this important? Well, if a client leaves that non-qualified annuity with all of that tax-deferred gain in that contract and only uses it for when they have a long-term care need that arises, now they're going to be taxed on any of that gain as they take that money out of that annuity. But there's a simple solution by just 1035 exchanging from that original annuity that they had into one of our PPA eligible annuity care solutions here at OneAmerica, where we can make all of that tax deferred to tax free for LTC. So a little slogan there, tax deferred to tax free for LTC. So what do I mean by that? The Pension Protection Act allows that 1035 into a PPA eligible annuity and can now make even that tax deferred gain tax free if it is used for long-term care expenses. So rather than leaving it where it was at and being taxed on the gain, why not 1035 that over simply by filling out an application and moving those funds from one annuity to another? And now if they have that long-term care event, they can realize the whole amount in that annuity, all income tax free if used for long-term care. Now, why it's no different, there's still going to be growth in these contracts. If they don't use it for long-term care, it's going to be taxed just like it was on the gain portion that was there in their original annuity. So it's really no skin off their back by just filling out an application and moving this over, and thus giving them the ability to use it tax-free if they have any long-term care expenditures. So I really like this play here, and I want to talk about one of the solutions in our annuity care portfolio that I really like right now, and I'm recommending quite a bit. And that is called our indexed annuity care. So the indexed annuity care on a base policy basis, and I'm going to go through this fairly quickly, if it's a single individual, we'll pay that annuity amount out over 24 months. If it's a joint annuity, and I'll get into that here in just a minute as well, it's paid out over a 30-month period. So they just 1035 that, or they take out this, using cash or whatever, but that amount is going to be paid again either over the 24 or 30 months, whether it's single or a joint. Now you can see the ages here, and this is what really blows me away. So we offer these solutions from age 40 all the way up to age 85. You don't find too many long-term care planning solutions out there that go up to age 85. So whether your client has forgot to plan, failed to plan, just now thinking of it later in life, maybe they had a traditional plan that was getting rate increases. They decided to just take the landing spots that the traditional carrier offered and now want to bolster some of that. these are great reasons to look to our indexed annuity care solutions. What this does is it automatically guarantees that there's going to be potential growth. There's a flat rate of 1% growth. The interest rate market is very low right now, as we all understand. But remember, these were designed specifically for long-term care. There are other annuities out there, maybe with a higher growth rate, but we also have a growth rate within the fixed indexed annuity that is potentially, or it's not potentially linked, it is linked to the S&P 500, and that has that protection from the downside risk. So there's the upside potential, but no downside risk. We've got 5 crediting strategies within this indexed annuity solution, and I'm not going to get into all of those today for the interest of time, but I just wanted you to know that that's kind of how the inner workings work. Now, you'll see it's tax-free for LTC, but there's a little asterisk there. We can use qualified money to fund these types of annuities as well. However, if we use qualified money, the base annuity itself will be taxable when they take that money out for long-term care. So I wanted to quickly point that out. Otherwise, if it was a non-qualified source, any of the LTC benefits will be tax-free. Now, I'm going to go into a scenario here in just a minute that covers a base-only annuity situation. And the reason I like to look at that is there is no telephone interview for a base-only contract. What do I mean by that? We've got 5 simple knockout questions, and if they can offer or answer no to all of those questions, we do a script check, an MIB check, and then it's accept or reject. That is all the underwriting that we do on a base-only annuity care solution. So pretty straightforward there, especially if you're getting to that upper age where they may have a lot more health history. However, we can add that rider. So that was the base policy, right? We can add a rider, the continuation of benefits rider, and that's on the right side of the screen here, that partitioned by that orangish red line there. So we can add a continuation of benefits rider that will extend that period once that base policy is exhausted for additional months or additional payouts. So we can double that original amount, triple that original amount, or one thing that really sets us apart in this annuity asset-based space is the fact that we have a lifetime option. So it can last for as long as they live. Those benefits would never run out. And that really sets us apart in this asset-based marketplace. We're the only carrier that has that unlimited lifetime option. So everything below here is really exactly the same as the base policy. But now I wanted to go into a quick just kind of illustration. So here we have a female in this hypothetical example, age 70, so it's just a single individual. She has a non-qualified annuity worth $150,000. So what we're going to do is 1035 exchange from where that original annuity was into our indexed annuity care base only solution. And we're going to use that full $150,000 to create her long-term care plan. When we 1035 that whole $150,000 comes over. And what does that create? It creates a really rich benefit for, again, a single female, age 70 here, $63.13 as up to $63.13 as a monthly LTC benefit for her. Now, if she doesn't have, $6,300 worth of care that is needed, that plan can extend for a longer period of time. So I wanted to point that out. But the reason I wanted to show this base only, again, remember, without adding that COB rider on this, we just have very simply 5 knockout questions. We do a script check and an MIB check, and it's accept or reject. So I wanted to give you just that quick scenario here. In the interest of time, I want to talk about the 1035 rules. because most of you may understand or know, or if you don't, I'm going to go through them quickly, that in a 1035 exchange, it must be a like-for-like provision. Meaning, if it's a singly owned annuity that you're 1035 over into another solution, it must still be singly owned. So pretty straightforward there. If it's a joint annuity structure, it must be jointly owned when they 1035. Those are the rules that we must play by. However, here at OneAmerica, we have what we can do is add an eligible person to that same contract that was individually owned. Now, it must be their spouse, but we can actually cover both spouses through that individually owned contract that we 1035 into our annuity care solution, and now have both spouses tap into that pool of funds for any long-term care expenditures. So really nice way of creating a joint plan, even for a singly owned individual annuity. All right. Now, one thing that I wanted to talk about, and I touched on this just a little bit, I'm going to switch over to our asset-based solution, our asset care solutions, which is our life-based chassis. And I really want to hit or focus on our lifetime payouts, that unlimited benefit amount. So you may recognize this well-balanced portfolio, but keeping with the themes now, again, of more control, less tax, larger inheritances, if we reposition a portion of their portfolio to create their long-term care plan and add a lifetime COB rider to that, and that can be for either a single individual or a couple, now we have put the ultimate peace of mind in their long-term care plan, knowing that either the individual or a couple can never run out of those long-term care benefits. They will always have income specifically geared towards long-term care expenses for as long as they live. So lifetime benefits, again, sets us apart here at OneAmerica, but I think it's a big piece when planning for long-term care, because nobody knows what the future is going to hold and how long they may need care. So let's look at that. You know, I'm going to focus on some averages here. I'm not, again, a big statistical seller here, but I need to kind of focus on this just a little bit. So by the averages, the average length of care need for men is 2.5 years. However, if we look at those claim periods as that average and peel away those that fall under a year of care, because, you know, there's a good portion of those that do fall under that year, but once they get past that year, that 2.5 now increases to 3.9 years. If we look at females, 3.8 years for women. But again, if we strip out any of those care needs that are under a year and look at a year plus, now that average for women is 5.2 years of care. Couple that with the rise of Alzheimer's, dementias, all of those that are on the rise out there. Really need to focus on this as well, because the average length of stay here is 6 years. However, that's just the average, right? Long-term care diagnoses or Alzheimer's diagnoses, dementia diagnoses can last well beyond the average. You know, 8, 10, 15, 20 years, people living with these dreaded diseases. So I just want to point these out. And, you know, there's some other statistics that I think are really good to point out here as well. And you may have heard of this one, that any of those Americans that are lucky enough to reach the age of 65, they have nearly a 70% chance of requiring some sort of long-term care services in their lifetime. So over a 70% chance, nearly a 70% chance by just reaching the ripe old age of 65. And of those needing that care, 20% of those are going to need care for 5 years or longer. So what I like to do is say, don't fall into that average trap. And this is why I think lifetime matters. I'm a kind of a visual learner, and so I wanted to give you just a visual cue here as well. Excuse me. I look at so many people planning for the average or falling into that average planning trap because they say, well, I'm just going to plan for the average, or tell me what the average need of care is. Let's just put a plan in place for that. Well, here's why I think lifetime matters. So this is a dot plot matrix of 200 claims. Each one of those blue dots is a claim. Now, if I bring in the average, I'm going to bring in that orangish line here again, and 9 of those dots actually fall directly on that average. So if they plan for the average, the plan worked great. You can see all those below the line that if planning for the average, those would have worked as well. However, look at all of those above the line. If they planned only for the average, now they're invading that same retirement portfolio that you've been helping them work with over the years, planning for that retirement. They're right back into invading that portfolio that they thought that they had a long-term care plan to protect. So why lifetime matters? This reason right here. We get rid of the line. Lifetime gives total peace of mind for the clients because each one of those blue dots, no matter how long, how short, how great that care need is, will have an automatic income stream for those long-term care expenses. So quickly, I wanted to talk about Asset Care single premium with our annual pay rider. So again, I'm talking about a base policy of a life insurance plan here, and then that COB rider. So we're going to single pay the base policy, but we're going to annual pay the rider. And why do I say that? We're seeing a lot more of this coming into us here at OneAmerica today. So I really wanted to point this out. So I'm going to focus on getting them, the clients here, male and female, both age 60, a $6,000 monthly benefit per person. In order to do that with a 3% acceleration of the death benefit, we need a $200,000 face amount. So the single premium for that base policy would be $119,086. However, to add that continuation of benefits rider, keep all of those same benefits available to each person, that $6,000 monthly benefit per person. Once they exhaust that policy, we need to add this continuation of benefits rider. And to do that, we're going to pay it on an annual basis. That annual premium then is $36.70 on an annual basis. So I really like this design, and I wanted to go into kind of the quote output here just to show you kind of how this works. So very quickly on the left-hand side here, the total initial premium, $122,000. That would be the base policy single premium plus the first year of the COB portion. It's a $200,000 face amount. That's all payable for LTC. You see that that line here coincides with that face amount. So once they exhaust that amount, that continuation of benefits kicks in and will continue to pay that $6,000 monthly or up to $6,000 monthly amount for long-term care expenses per person for as long as they both would live. More things that I like to point out here, we always break out the LTC premium if you have any clients who are business owners. I point this out because LTC premiums have the availability of deductibility. Even on an individual basis, we just don't see it a whole lot on an individual basis because the standard deduction has raised so high. I don't have time to get into this whole tax deduction on the business side, but just think about this and know that we always break out that LTC premium for those business owner clients. We can always talk to your marketing rep there at Financial Markets. They can certainly help you with any of that tax deduction piece. The other thing I like to point out here, anytime we've got recurring premiums on a plan with us, waiver of premium kicks in. So if one of those clients would happen to go on claim, waiver of premium would kick in and no more premiums would be due. So I like to point that out here on the ledger pages as well. You can see the initial payment up front. That would be the single pay on the base plus the first COB payment, and then those ongoing payments. But again, let's say in year 13, one of those clients goes on claim, they would have no more recurring premiums due because waiver of premium would kick in. All right, I told you we could use qualified funds. And I know we're getting past my time here, so I want to quickly run through this example as well. So let's say your client has an IRA out there of $200,000. We can use those IRA funds through just a direct trustee-to-trustee transfer. So a direct rollover into OneAmerica's solutions. So we can use those qualified funds. We directly roll that over into what we call our annuity-funded whole life solution here at OneAmerica. And once we roll that over, we give it a nice 10% bonus right off the top. So that $200,000 now becomes $220,000. Now we're going to use this total $220,000 to fund the life-based policy over 10 years. So we break that up into 10 equal parts to fund that 10-pay life setup. So breaking that $220,000 into 10 equal distribution parts, $22,000, that funds our base policy and the continuation of benefits rider for this particular situation. Again, male and female, age 60 here. I like to give it this little hourglass because I think that gives a little bit of a visualization around how this solution works. But let's look at it a little bit more in depth. So that single premium IRA was directly transferred over to us. We give it that 10% bonus. So that is now the 10-pay life policy of $220,000 that we have to use for that 10-pay policy. That creates a face amount for this couple of $219,539, and then we'll give them over $6,500 in monthly LTC benefits per person, and that continues for the life of either of them. So this is a great way to use some of the qualified funds that may happen to be out there. Again, here's your ledger pages. I think it really goes to speak to exactly how this is done. Funded over 10 years, always creates the LTC benefits that are available for each person per month. So again, remembering that your client wants more control and how those funds can be used, less taxes, and to pass on larger inheritances. All of these solutions, which I've quickly presented today, will hit on these three things. So with that, I think we've got a little time left for Q&A. Ed, I will open it up for any questions that may be out there.
Sure. Again, folks, if you want to send a question to us, go ahead and use the toolbar there that's got the chat. One question that came up here was on the life side of the solutions underwriting there. Can you kind of give us this panoramic view currently of what kind of where the rubber meets the road on the cycle of the underwriting that's done on the life side there, Brent?
Yeah, great question, and certainly appreciate that. So largely the I think the question hones in on our service levels or our turnaround times where we stand currently. I want to address one thing with this. Our turnaround times right now are outside of their norms. largely that was due to, maybe some of you know, maybe some of you don't, Washington, the state of Washington, put in a taxation on all of their constituents. Now, there's been some changes to regulation, and they've pushed that taxation off for another year to maybe make some tweaks to that. But what that did is made many of the Washington constituents go out and find their own LTC coverage, because if they had their own plan, they would be able to forego that tax. So what this did was really flooded the whole marketplace, not just OneAmerica, but anybody offering any type of LTC coverage, flooded the marketplace with applications. The state of Washington didn't work with any of the carriers out there to really kind of mitigate this or really plan for much of this. They just rolled it out, and lo and behold, a lot of applications came in. Let me just give you a quick example of what happened with us here at OneAmerica. In January of 2021, so last year, we had 16 applications after the month of January from the state of Washington. The last day that we made available to the constituents of Washington for any of our solutions was August 16th of last year, of 2021. We got 2,600 applications in the home office in one day. Just by that little example, I think you can see how that really flooded the market and created, unfortunately, what is called what I'll call a pig in the python. So we have been diligently working to improve our turnaround times. One thing that is really helping us now is the state of Washington pushing off that tax, knowing that there was a lot of applications that we were still working on for the state of Washington. Those have now either subsided, made it through the process, or we have stopped processing those apps. And leadership has promised us that our turnaround times will be back to normal by somewhere in the vicinity of February 15th to March 1st. So I tell you that because, you know, what is that? We're talking 3-4 weeks here. Every long-term care, you know, representation takes maybe a few weeks even to speak with your clients, let them make a decision, take an application. By the time you have an application come in, we should be back to more normal turnaround times. But I did need to address the elephant in the room, that our turnaround times are well beyond where they should be, but we are making vast improvements, largely due to the Washington reduction in many of those applications out there. So good, very long-winded answer, Ed, but thank you for the question.
You bet. A question came in, and maybe this is alluding to then the annuity portion, where then I think you said if there was continuation of benefits, there were then some questions that were done. What are some of those knockout illnesses then, if that is in the request for the coverage? Are there some particular knockout illnesses that will then disqualify them?
Yeah, from the top of my head, and I may not get these all right here, but you know, if we're looking at maybe just the base only and just the 5 knockout questions, here are some of the questions. Are they using any assistive devices? So wheelchair, walker, you know, quad cane, stuff like that. That's one knockout question. Have they been diagnosed with Alzheimer's, dementia, that sort of thing? That's another knockout question. Have they ever had AIDS or HIV? Are they, let's see, there's 2 more. Are they, I think I said, are they currently are they currently receiving any type of ADL assistance? That's the 4th question. And then lastly, are they receiving any Social Security disability? So those are the 5 knockout questions that are on a base-only annuity contract. If we add the COB portion, then we will have a telephone interview that really speaks more to the cognitive piece of that individual. So that's where the COB will have that cognitive piece. And if I look to the life side, we're always going to have that cognitive telephone interview as well. So I wanted to just speak to the differences there. So it was a great question in asking, what the 5 knockouts are, and then what that telephone interview cognitive piece would look like as well.
Okay, very good. On the life side, the premiums never increase?
That is correct. This is based on a life chassis or an annuity chassis, and either way, these are guaranteed premiums up front, so they can never increase. And that's what makes them a lot more attractive to Americans out there who haven't planned versus the traditional market. Now, I will never bash the traditional market. I came from that market, spent many years in that marketplace. There's a time and place for those particular solutions. However, the fact that our premiums will never increase is something that many advisors, insurance professionals like to represent to their clients, so they'll never be caught off guard.
And on the life side, there is an option of a return to premium?
We do have a return to premium option as well. We do put some limitations on what that plan can look like. Largely, there is no lifetime benefits on our return to premium scenario. It must be a 2% acceleration, meaning we'll spread that out over 50 months. And so the COB would be an additional 50 months. So really a 100-month payout there. But if they want to retain their liquidity, our return to premium option is a good solution for clients out there as well.
Okay, very good. A final question here, and this goes to the group that's listening today. In my almost 50 years, I found if you have the product yourself, it's a lot easier to explain it. And you've got some so-called skin in the game as you're explaining it to your clients. So of the group, how many of you have long-term care? Of the group, how many of your parents or maybe your in-laws have long-term care? On my side, I do. On my side, my in-laws do, but my mother does not. My mother does not have long-term care. Oh, she lives in Panama. It's not available in the country of Panama. So we've had some real good tools here, and we thank you. And I would plant this seed with you folks. If you want to look continually to sharpen your axe on this risk of long-term care, do not hesitate to contact your internal wholesaler. That idea there of the business owner, whether it be big business owner or small business owner, and they can kind of cherry pick there the benefits itself and the deductibility of that, contact your internal wholesaler there. How to look at more tools for them to control and have less taxes and then pass more on to their heirs. Contact your internal wholesaler there. And where should it be, that annuity? They may say, well, in my lockbox. It still opens up for you to then explain to them the risk that they're taking by not having long-term care. So Brent, thank you very much. Before I turn it over to Neil here for the drawing, the $50 gift card, I'd like to then look down the road here a little bit, and you can already mark your calendar on February the 16th. The February 16th will be the next opportunity that we're going to have to help you sharpen your axe that we have there. And I would be remiss if I didn't bring up that financial markets already hitting the ground, and we have a March Madness giveaway in which one lucky winner is going to be able to choose a locking gun safe or a flat screen smart TV. And that's from the business that you write and place from January the 3rd all the way up to April 1st of 2022. So now I turn it over to Neil, and he can do the drawing for us.
Thank you, Ed. Thank you, Brent. Great presentation here today. There were two other questions. Maybe you didn't see those, Ed, and considering the time that we're at, Brent, we'll try to make them short and sweet. But the first question is, in the $200,000 IRA example, what happens to the taxes due on that IRA? I think she's referring, or he is referring to the $200,000 that did the annuity funded whole life?
Yeah, the distribution. Thank you for that question, because I forgot to mention that in the interest of time. So those 10 equal payouts that are going to fund the 10-pay life portion of this long-term care solution, those equal payouts will create a taxable event. So we're spreading that risk out over those 10 years. So they will get a 1099 LTC for those 10 equal distributions. So unfortunately, yes, the IRS must get their money if it's a qualified situation. So there is a taxable portion for that. I will try and do this as quickly as possible. A couple other things to think about with that solution. Those distributions, if your clients are RMD eligible, those distributions can satisfy their RMD if they're just looking for ways to, not take out their RMDs, and also inherited IRAs because of the new Secure Act rules. Inherited IRAs must be drained in 10 years, so that solution works very well, even for those under age 59 and a half, because that 10% penalty does not apply to them due to the Secure Act rules. So great situation for any of those inherited IRAs out there. So that's my shortest answer I can give.
Thanks, Brent. Hey, one last question that was posted. Do couples need to be married or can they be cohabitants to do a joint plan?
Yeah, in most situations on our asset care, which is our life-based chassis, it doesn't matter. We'll take all of the avenues, if you will, that are recognized by the state. So can be, domestic partnership, same-sex partners, whatever. As long as it's recognized by the state, we will take that as a joint case for our life side. On the annuity side, if we're adding that eligible individual, they must be a spouse. So that is IRS and NAIC rules there around that.
Very good. All right, folks. Well, thank you so much for joining us. Thank you for the information here as well, Brent. And so everybody that's been on the call has been placed in the hat for the $50 Amazon gift card drawing. And we'll throw those in the hat and see who our winner is. And Gerald Anderson. Let's make sure he's still on the call, and he sure is. So congratulations, Gerald, on winning the $50 Amazon gift card and all the information that we all gathered. Hey, we're all winners. I'll turn it back to you, Ed.
Yeah, thank you so much. Well, folks, go forth and take on the day, and remember, life is an opportunity. We can all benefit from it. Take care and look forward to seeing you on February the 16th for our next time that we can sharpen our axe. Take care.